Hey, good morning, everybody. Welcome to the last Monday of July 2019. The markets are kind of a little, iffy this morning. Not a lot of earnings stuff hitting the news. A lot of stuff after the markets today. So, but I did want to remind you about a couple things as we head into this last week of July, and it's not even a full week of July. Remember, we will be Thursday starts the 1st of August. So, hey, a must-do report we've got out. Market corrections, we continue to talk about how high the market is. And so a correction is, a lot of people are calling for a correction. So, hey, we've put out this report on understanding market corrections and what they may mean to you. And so to get your free report, all you have to do is text the word market to 863-285-3815, or here on Facebook, all you have to do is click the link right above and it'll take you right to the page to get it. So, hey, Dave will be with us in just a moment. Hang tight.
105.7 Light FM. Good morning. It's 8:38 here, 22 before 9. It is going to be a very, very eventful week in the world of finances. But I can tell you up front, it's a very, very quiet Monday in the world of finances. Phillip, Statler, and I were just saying, okay, what the heck's going on? Well, not a whole heck of a lot on Monday. Let's go downtown, find out how your IRA and 401k are doing this morning. Phillip Statler is on the line from Statler Financial Services in downtown Sebring. Phillip, hi there.
Hey, buddy, how's it going?
Well, quiet. How's that grab you? Not much.
It is quiet. Like I was telling you before we went on the air, I was looking and thinking, we're talking about being in the heart of earnings season, and there's nothing to talk about on a company basis, really. So I went back and looked, and so here's the deal. On Friday, everybody reported earnings before the market opened, so we had lots to talk about. Mm-hmm. And today, everybody pretty much is reporting after the market closes. So that's why there's kind of a little lull here.
It does give us a kind of a quiet period, which gives us a chance to talk a little bit about the Federal Reserve. 2-day meeting for the Fed this week, Tuesday and Wednesday, 2 o'clock on Wednesday. We get the Federal Reserve's interest rate decision. And I really, honest to God, don't know what the market's reaction would be for any of about 8 different decisions. You said that some of your odds makers are talking about the possibility of a 0.75 point cut. I was reading one of my tip sheets saying that they're expecting a 0.25 point cut, like 3 or 4 meetings in a row. Some folks were saying a 0.5 point in one run. What's the market expecting? We got some sort of a cut baked in. I know that.
Well, I think you're right. We have a cut definitely baked in. The question is, how's it baked in? What are they really expecting? And nobody's really saying. Early on in the year or in the quarter, they're really talking about 0.5% first and then 0.25% after in the next meeting. And so I think you referred to a report that basically says a quarter for the next 3 meetings. Either way you slice it, that's 0.75%. I don't know if there's really the need for 0.75%. Going forward. I noticed Janet Yellen has kind of chimed in and agrees that there should be a rate cut. So that's adding even more credence to the fact that I think we can expect to see a cut on Wednesday.
And you and I pretty much are of one mind that a cut wouldn't hurt at this moment, but too aggressive a cutting, we take all the tools out for the inevitable recession that is going to end up happening. If they go down 0.75% over the next even 3 months, we're looking at the notion of when we do actually have that flattening time in the economy, when we actually do slow down and maybe, heaven forbid, turn negative, what's the Fed going to do then? Start buying mortgages again?
Yeah, exactly. So, are we putting ourselves in a hole, in a pinch that could really cost us some issues down the road? I think it's funny that I can't remember I was talking about. I was reading an article, and I can't remember exactly who it was, but somebody overseas was saying, the only place that the United States has inflation is in the stock market, and that they shouldn't be lowering interest rates because there's no need to.
And that's it may be a little bit blunt, but it's not completely inaccurate. I mean, the best indication that I've got in the process, my fetish for watching the earnings per share, watching the price earnings ratios on the indexes. There's room to go up if expectation was for no recession or flattening out. But the bottom line is, we're pretty much just tracking the median earnings on the median earnings and median profit. Price earnings ratio on the indexes and kind of just tracking it upward, and we're not really getting overly aggressive. That indicates the stock market realizes something is going to go on before too terribly long.
Well, that's true. And so, we talked last week about, all those people now are coming out. The big bank people are coming out, and the research people, hey, we see a correction coming. They didn't see a bear market coming necessarily, but they're talking about a correction and a hard correction. But who knows? I mean, we've seen this thing run and run and run, and how long is it going to run before it starts to correct? I mean, we're already in record territory, not just in price, but in length of time for the bull market.
Absolutely, and it's now getting to the point, even with those of us that quibble as to when you actually say the bull market actually began, it's lasted an inordinately long time. And yeah, as you say, introducing new records even as we go. The NASDAQ up 91 points again on Friday. That set a new all-time closing record, and the Dow and the S&P are not far off their record highs either. And the thing is, as we look at earnings season, we've had some blemishes on these reports that have come out as the analysts are looking at the metrics that we haven't even monitored that carefully and saying, whoa, we're not going to give this particular stock a bump because, they missed a number of beans per location or whatever, a new metric you and I hadn't watched that carefully.
Well, that's true. But let's talk about a couple of things that are kind of starting to hit the road anyway that I'm seeing is we're seeing some downgrades and some household names getting downgraded. Domino's, Starbucks. There's who else did I see? I saw somebody else got downgraded significantly. So we're seeing some of the analysts come out and say, look, this thing's run and run and run. There's not much more potential for profit in addition to what we've already seen. The only way that we think they're going to go other than up maybe a little bit more is down. And so we think you should get out now and secure your profits.
I was going to say the dominant item on my news ticker this morning were downgrades of stocks that I honestly thought had done pretty well off of their quarterly reports last week when we talked about it. It does seem to fit. Do your analysts that you read have any kind of a reading as to how much of an interest rate cut is baked into the market right now? My instinct, given what happened last week when we had the rumor out that 0.5% wasn't going to happen, which I never thought it was, we've baked in 0.25%. If we get more than that on Wednesday, we're going to have party time and a dose of heroin into the indexes.
I would agree with you, Dave. I mean, I think that I don't think people are expecting more than 0.25 point. At least I wouldn't think so. I mean, there's just not. The other side of the people is that, hey, there shouldn't be any decrease at all. We should just hold our own. And so I think if we get more than 0.25 point, you're right. It's going to juice the markets for no reason.
Absolutely. The other implication on this as well is in a time of decreasing interest rates, that does kind of put a different spin on which stocks many of these investors are looking at, because as interest rates go down, dividend stocks suddenly start getting more interesting than they did a while ago.
Well, they do, but the other thing happens to them, Dave, is that as the price of the stock goes up, the yield on the dividend goes down. And so as this market continues to rock along, now maybe it's better than what they can get at the banks or money markets. I'm sure it is. But you still have to look at, okay, I'm buying this stock, and if it's, if I look at it as overpriced, but I'm buying it for the dividend, well, you better be happy for the dividend for a long term, because, the price of the stock may go down and you lose on the long term.
Absolutely. A 2.5% dividend doesn't sound half bad if the interest rate you can get off of your money on the bond market is only about 1.1%, right?
But exactly, especially on shorter term. But again, short term, that dividend paying stock can take a dip in a hurry, and you get caught holding it.
That's absolutely true. Setting the table for this morning, and as it's obvious, it's a relatively slow news day, so we're prognosticating as we go. Friday's close was green ink all the way across the board. It was kind of seafoam green for the Dow and the S&P. Dow was up by 0.19%, up 51.5. Standard & Poor's up 22 points. That was 0.75 point, not half bad, but the NASDAQ had party time off of some good news they got from some of the biggies. Earning reports came out earlier in the week, up 91.5 points. That's well over 1% on Friday. 45 minutes before we throw money around this morning, Phillip, I'm going to assume we're going to be pretty conservative until the Fed report comes out midweek. Where are we going early this morning?
Yeah, it's pretty flat today. We've got earnings basically, or not earnings. We've got the market up, and there it's all in green, Dave. It's green across the board, but it's like less than 0.1% in any one index. So we've got the Dow Jones up $15, the S&P up $1, NASDAQ up 6. Same thing with gold and silver. We're not seeing much of a move there either. And crude oil is up at $56.28 a barrel, which is up a little bit from Friday's close.
But it's about where it was at the end of the week last week. It looks like we got that trading range now that they've reopened the Gulf platforms, huh?
Yeah, I think so.
Yeah, we'll take that happily. By and large, overseas markets, Asian Rim was mostly off at the close early this morning. Europe trading up. They're having a party over in England. I think we're going to start calling it the Boris bounce. Phillip, somebody need to get some reassurance that retirement can still happen with the right strategy. How does somebody get a hold of you to make an appointment?
Dave, I think we need to talk about having a retirement coach to make sure that you're got an exit strategy in place. So for our free financial x-ray analysis of your current portfolio, give us a call at 382-0037. Make sure you don't have too much risk in your portfolio. And we still have our Understanding Market Corrections report out there. All you have to do is text the word market to 863-285-3815. Join us every weekend, Dave, for the Statler Financial Radio Show, noon on Saturdays, 10 a.m. Sunday mornings.
And early Saturday mornings, I believe, starting this week.
Is it coming out this week? I wasn't sure exactly when it was going to start. So, yep, is it 6 o'clock?
Yep, you're going to wake up way early on Saturday mornings these days. All right. An extra bonus report at 6 o'clock on Saturday mornings on News Talk 730 and streaming at newstalk730am.com. Phillip, thank you so much, and we'll see you tomorrow, all right?
All right, buddy. Take care.
Thank you, my friend. It's 1:05.
Hey, folks, I hope you enjoyed it today. I know it was a little bit, we had to kind of make it as we went today because there's not much in the way of earnings today. So, but again, I want to remind you about our free report on understanding market corrections. Text the word market to 863-285-3815 or click the link right above this post. And hey, until tomorrow, have a great day. I look forward to speaking to you then. Bye now.